In this episode, I will explain the characteristics of valid liquidity pools. Most traders mark random liquidity levels, only to watch them fail. By the end of this video, you will clearly understand where high probability moves are most likely to occur. So, let's get into it. Once you understand this, everything else about liquidity, previous highs and lows, and sessions becomes much easier to frame. After this, we'll move into previous months, high and low, previous weeks high and low, previous days high and low, and then we'll talk about sessions and the liquidity that forms during each session and how it can be used throughout the trading day. Now, there are only three ways a candlestick can form. The first is consolidation. A consolidation candle is one that does not take out the previous candle's high and does not take out the previous candle's low. In other words, it fails to run buy-side liquidity and it fails to run sell-side liquidity. Price is contained within the previous range. There is no expansion. There is no aggressive displacement. It is simply compressing. When this happens, we know liquidity is building on both sides of the range, and we can anticipate that eventually one side will be taken. The second thing price can do is take out one side of the range. For example, price may take out the previous candle's high, meaning it runs buy-side liquidity, but it does not take out the previous candle's low. That is a one-sided directional move. This tells us that price expanded in one direction during that time period. The same applies in reverse. Price can take out the previous candle's low, running sell-side liquidity, but fail to take out the previous high. Again, this is a one-sided move. It shows directional intent during that period. The third and final thing price can do is take out both sides of the range. In this situation, price runs buy-side liquidity and sell-side liquidity within the same candle. It takes out the previous high and the previous low. This is what we call a two-sided move. This usually represents manipulation or a candle that is seeking liquidity on both sides before deciding direction. So to summarize, every candle is either consolidating, taking one side, or taking both sides. There's nothing else it can do. If price is not consolidating, then it is seeking liquidity. That means I can anticipate price moving toward the previous candle's high, the previous candle's low, or in some cases both. And this is exactly why it is critical to know where previous highs and lows are located across multiple time frames. Those levels represent liquidity, and price is constantly moving from one pool of liquidity to the next. Now that we understand what a single candle can do, we can start layering this concept into previous month highs and lows, previous week highs and lows, previous day highs and lows, and session liquidity. Now we are going to look at previous month's high and previous month's low. Just like we discussed in the previous section, unless price is in consolidation, it is always seeking liquidity. That means it is generally moving toward one side of a range, or in some cases, both sides. When we zoom out to the monthly time frame, the previous month's high and the previous month's low become major liquidity pools. These are large reference points that institutions and higher time frame participants are aware of. Because of that, they often act as magnets for price. So let's break down the two main ways these levels are used. In the first scenario, price reaches the previous month's low. When it does that, it runs sell-side liquidity resting below that low. After that liquidity is taken, we often see a reaction. That reaction can form a reversal, and price may then trade back into the range. In this case, the previous month's low acted as a draw on liquidity and then a reversal point. In the second scenario, price does not reverse. Instead, it continues seeking liquidity and pushes directly toward the previous month's high. In that case, the previous month's high becomes the draw on liquidity. Price is simply expanding from one external liquidity pool to the other. So you can see that previous month's highs and lows help us frame bias. They give us external range boundaries. They tell us where price may be drawing toward and where a potential reversal could occur. These levels are not random lines on a chart. They are reference points for liquidity. And once you understand that price is constantly moving from liquidity to liquidity, these highs and lows become extremely powerful tools for framing direction. Now let's go take a look at this concept on an actual chart so you can see how price interacts with previous month's high and low in real market conditions. So here we are on gold on the daily chart. I have marked out the current month's high and low with solid lines. Then I extended those levels into the following month using dotted lines. Those dotted lines represent the previous month's high and the previous month's low. These are external liquidity pools. Now watch how price reacts around them. In this month right here, price trades down and reaches for the previous month's low first. That level acts as a draw on liquidity. Once sell-side liquidity resting below that low is taken, price continues lower. That shows us that sometimes these levels are not immediate reversal points, but rather magnets that price must reach before expanding further. Then, in the next phase, price trades higher and reaches for the previous month's high. Once that buy-side liquidity is taken, we see a reaction and a reversal. That is a classic example of price using the previous month's high to frame a reversal. After that, price once again draws toward the previous month's low, and then again, and again. You can clearly see that price is not randomly moving. It is constantly being drawn toward these higher time frame liquidity levels. Either it reaches them and reverses, or it reaches them and continues expanding through them. But in almost every case, it acknowledges them. This is why marking previous month's high and low is so important. They give you structure. They help you understand where price is likely to draw next. And they help you frame whether you are trading into liquidity or away from it. Once you combine this with structure, session timing, and your entry model, these levels become even more powerful. Now getting back into the PDF, the exact same concept applies on the weekly time frame. Just like we used previous month's high and low as external liquidity, we can use previous week's high and previous week's low in the same way. The only difference is the time frame, not the logic. Here in this first example, you can see price reaches down into the previous week's low. That level acts as a liquidity pool. Once that sell-side liquidity is taken, we see a reaction. Price forms a reversal and then expands higher, eventually reaching for the previous week's high. So in this case, previous week's low framed the reversal, and previous week's high became the draw on liquidity. Now looking at the example below, you can see a different outcome. Price reaches for the previous week's low, but instead of reversing aggressively, it uses that level simply as a draw on liquidity before continuing lower. So again, the level was respected in the sense that price was drawn toward it, but it did not necessarily cause a long-term reversal. This is the key idea. Previous week's highs and lows are liquidity magnets. Price will often move toward them. Once reached, one of two things generally happens. Either price reverses from that liquidity pool, or it uses that liquidity to fuel continuation in the same direction. That is why marking previous week's high and low at the start of every week is so powerful. It gives you higher time frame context. It helps you understand whether you are trading into liquidity or trading away from it. And when you align this with structure and your session timing, it becomes much easier to frame high probability setups. So here we are on the weekly time frame, and just like with the monthly levels, the same concepts apply. The only difference is the time frame. Instead of previous month's high and low, we are now focusing on previous week's high and previous week's low. Right here, price trades below the previous week's low and closes lower. Since we are trending down overall, I can anticipate that price is more likely to continue reaching for sell-side liquidity. In that situation, previous week's low becomes the more probable draw on liquidity rather than the high. As we move forward, we hit previous week's low, but fail to show strong displacement or a decisive close away from the range. That lack of commitment suggests price may now reach for the opposite side, which is previous week's high. And as you can see, price eventually trades up into that previous week's high. Here there is not much displacement or clear direction. The candle is more indecisive. When you see indecision like that, price can reach for either side of the range. Then we get displacement and a close. When we close with strength, I have to ask where the next logical liquidity pool is. Based on the displacement and structure, previous week's high becomes the more probable target. Later, we displace out and close back into the range. You can also see that price trades into a fair value gap in this area. With that context, I would anticipate price reaching for previous week's low next, and that is exactly what happens. Again, we close back inside. Similar to the earlier indecision candle, price could reach either side. But once we get more displacement lower, and we are closing near previous week's low, it increases the probability that price continues reaching for that liquidity. The main point of walking through price action like this is to show that on a weekly time frame, unless price is clearly consolidating, it is generally reaching for a high or a low. Previous week's highs and lows act as liquidity pools. They help you understand where price is likely to draw next and whether you are trading into liquidity or away from it. That is why it is important to have them marked on your chart. All right, so that wraps up previous month's high and low and previous week's high and low. The main thing I want you to understand is that these levels are not random. They are higher time frame liquidity pools. Unless price is consolidating, it is usually reaching for one side of the range. These levels help you frame where price is likely drawing next and whether a move is continuation or reversal. Now, I am not going to make this video any longer. In the next part, I will cover the other important levels and show you how they all align together. So stay tuned for part 2. If this helped you, make sure you like the video, subscribe to the channel, and share it with someone who needs to understand liquidity properly. I will see you in the next one.